Hey everyone, today is September 10th, 2020. Ever since Nasdaq reached its historical high on September the 2nd, we saw the market going downwards. It took the market 3 days to wipe out the entire rise from August to September. But then there's a typical rebound after 3 days crash. Lots of people ask, is it time to buy the dip? Is another huge run ahead of us? What should I buy? Before getting into those answers, the only thing I would ask for a return of this video is for you to smash that ravishing like button. This is a graph of QQQ. QQQ is the Nasdaq 100 Index ETF. It indicates the overall performance of all the major tech stocks. Since this crash is mainly due to the tech stocks, technical analysis on QQQ is very important to determine where the market is heading. QQQ rebounded very quickly since March the crash and kept setting historical highs. On September 2nd, QQQ reached its historical high, but followed by 3 big red days. Same as the old saying, get back in after market goes down for 3 days. It bounced back a little yesterday, and today the market opened up high but kept on decreasing. Typical trap mode. Where is this heading? Upwards? Downwards? I can't predict tomorrow. Otherwise, I wouldn't be here. But I can make my move smartly to minimize the risk while maintaining the profit. In order to know my next move, I need to figure out the profit-loss ratio. I'll just use an example to illustrate if you're not familiar with this ratio. Imagine I'm playing games with this beautiful girl. If I win, I'm allowed to hold her hand. And if she wins, she can stab me in the back. No matter how beautiful she is, I probably wouldn't play that game. This is true for lots of scenarios, including buying stocks. With the profit-loss theory in mind, let's see if I should buy in now. What room do we have going up? What room do we have going down? We can see 303 is the highest the QQQ has reached, and 164 is the lowest on the worst day in March. I don't think we're getting down there though, so it's not captured here. But still, we have a lot more downward potential. Of course, new highs can break the ceiling, but first, September has usually been a bad performance month historically. Second, the election is coming. Higher volatility for sure. In my last video, I mentioned that the Federal Reserve will keep supporting the market. But to what extent? If I were the chairman, which is easier? Holding it in a certain range without too much effort so that I can save some energy for worst case scenario, or raising it as high as possible to a point where I can no longer hold and let it fall on me. The answer is very clear to me, but feel free to have other answers. Third, the volume is pretty weak during the previous day's rebounds, which gives me the impression that institutions and bankers are collecting their profit and walk away. No wonder. Today it opened up high to lure individuals in and bury them afterwards. Since the QQQ price probably won't fall down to 164, then at what point do I know that the market has stabilized or ready to turn around? Understanding supporting level can help us answer those questions. If you draw a line from left to right in those red box areas, you can see they're roughly flat. These almost flat lines are what we call the supporting levels. They are on a candlestick graph, show the price has been vibrating around the level for a period of time. This level is in an area where the chips have enough time to change owners. Most short-term traders got out. Whoever is still holding the stock has relatively strong faith in the company's future. The chance for them to do panic selling is a lot lower. Support level is like trenches dug on the battlefield. When the enemy is attacking, you can hold on to your position, hide in the trench with guys you can trust, and stop the enemy a few times. Without taking time and money to build the trench, you guys probably wouldn't give your backs to each other. Instead, you're going to try to see who can run faster. Most likely, both ended up being slaughtered by the enemy. Understanding the supporting level a bit better, we can take a look here. Since August, the stock price has been going up fairly quickly with very little adjustments. This is a bad sign, meaning a lot of people knew the market wasn't reasonable, but still bet that it would keep rising. Then, without any specific news, the market crashed for 3 days. The profit in a whole month went back in 3 days. As shown here, the market just tested the first supporting level at around 270. I think the breakthrough is coming anytime. Only 1 week's time to build this supporting level, not enough for all the upcoming uncertainties. If lucky, we might be able to hold the 260 supporting level, but I'm not very optimistic on that either. According to the analysts, even after the crash, most of the high-tech stocks are still overvalued by 10 to 20%. Since the institutions have made so much profits over the summer, with the upcoming uncertainties like election, vaccine, I think they'll walk away with a full pocket and wait for a better time to enter. After that, it's 240, 220, etc. Same theory. So what to do? For long-term investors, it probably doesn't matter so long as they have good understanding and strong faith of what they are buying. But I believe most people here are more like swing traders. If the stock price crashed at 20 to 30% and they didn't get out, then they started to claim they are long-term investors. Personally, I would grab the profit every time it rebounces and temporarily put my money elsewhere. One of the choices is to put money in the bank, stand by and watching. I doubt anybody listening to my video would want to do that. With the money printing speed currently, if I leave the money in the bank, the value depreciates really fast. Another choice is to find a good company that has not been overvalued too much. Even if they got dragged down by the whole market, they will recover fairly soon. For example, Disney. I had a video talking about that. Last but not least, in October, the deal airlines made with the government will expire. They can start laying off people. Cruel for the employees, but good for the company's financial situation. Their stock price has been on the ground for so long. Shareholders who didn't have faith have already been shaken out. Even with yesterday's AstraZeneca news that the third stage test of their vaccine has been halted due to severe side effect, airline stocks handled it pretty well. A couple of percent down in 1 day and came back the next. I would rather buy those and wait for the turnaround, either after the vaccine is out or when people can no longer stay hiding at home. Not sure which one comes first. In summary, it would be better to stay away from the extremely overvalued tech stock like Tesla, Apple. Not to say they're not great companies, simply because they're too expensive. It might force you to be a long-term investor. I'd rather make my own choices. In the next video, I will show you how I analyze a stock, rate it, and set risk factor for it. And there will be some stocks I'm about to add on. If you find this video is helpful, Please like, subscribe, and share it. Thanks for watching. See you next time.